Hey, what's going on, guys? Trevor here. Welcome back to another video. So in today's episode, we're going to be talking about how to prepare for a stock market crash. Now, the point of this video is to not scare you, but to prepare you, just in case we do have one. I'm not saying we're going to have one anytime soon, but I'd rather you guys be prepared. I'm going to give you guys 6 things that I personally follow that put me in a position to not only take advantage of stock market crashes, but also be prepared for it mentally, okay? So there's a good chance. I've been talking to a lot of new people on this channel. I've been getting a lot of new subscribers recently. Welcome to the channel. I'm very happy you guys are here. And I get a lot of people messaging me, are we going to have a stock market crash? And they're kind of panicking about the future of the markets. Now, I think a big reason that they're panicking here is because a lot of these newer investors started in like March or April of 2020. And since then, guys, all we've seen is something like this, right? A lot of newer investors, especially within the past couple months, have not experienced a ton of volatility in the market. So this video is titled How to Prepare for a Stock Market Crash, but you can also look at it from a perspective of how to prepare for volatility within the market, okay? So with that being said, guys, thank you so much for taking the time to watch this video. I hope you get a ton of value from it, and let's get into it. So the first way that we can prepare for volatility or a stock market crash is to establish an emergency fund. This is so crucial, guys. I personally recommend 3 to 6 months of expenses. That's what I've learned over the past couple years from various financial coaches and YouTube channels. And it seems to be that is like the general recommendation for how long you should have your emergency fund, 3 to 6 months. Some people may disagree with that and say you should have, a year emergency fund. I've known people that have 5-year emergency funds. And I've also had people that, have maybe a 1-month emergency fund. But the fact is, most Americans don't even have an emergency fund. So the point is, you want to establish an emergency fund. You want to figure out how long is right for you. Do you want to do 3 to 6 months? Do you want to do a year? Whatever's more comfortable for you. But having an emergency fund is absolutely crucial. It puts you in a position that you're not so attached to, crazy things going on, whether it's in the stock market or just overall economy. It gives you that extra cushion that I really think that a lot of people can benefit from. So, this is very crucial just because we never know what can happen with, our income source, our job, our business. You take a look back at March of 2020, a lot of people and a lot of businesses started to, have to lay off employees. And a lot of these people probably thought their job would never be affected, right? It was almost like an essential job. But once we got into that time, a lot of people realized like, hey, my job isn't as secure, as I thought it would be. So it's definitely something to think about. Definitely something that I think a lot of us learned, that our job is maybe not as secure as we thought it would be. So, this is why it's really important that everybody has an emergency fund. I personally think everyone should have it, okay? So second thing we can do to prepare for a stock market crash is to pay off debt. Now, a lot of people, I think, don't really talk about this one. I haven't really heard it, being talked about when preparing for a stock market crash. But I would suggest the Dave Ramsey approach, okay? I'm a big follower of Dave Ramsey. I agree with him on, some things. I disagree with him on some things, but that's for another video. So you could follow a couple methods that he has that I personally think are very, very valuable and very, very effective ways of paying off consumer debt. Now, I've talked about this in previous videos. We go over the avalanche method by Dave Ramsey, and we also go over the snowball method. But again, I think that paying off any high interest rate debt will put you in a position of being able to not only contribute more money to the market during a stock market crash when you can maybe pick up some more stocks at a cheaper valuation, but it also just gives you more capital to have access to, right? Having extra cash is always a great thing when you're investing in the stock market, or you're just wanting that extra peace of mind. It's always not a bad thing to have. So I'm an example of this, guys. Like personally, I don't make a ton of money at all, and what I've done personally is I've minimized my expenses. And I don't have any debt, and I make sure that, I paid off my car. I made sure that I'm debt-free, right? Even though my income may not be the greatest, I'm not liable to anything. I don't have any debt. So that's where I can invest most of the money that I'm making into the stock market, into a business, into anything I want to do, because I'm not, attached to any debt. So a lot of people think it's increased my income so that I'm able to invest more in the stock market. And while that definitely would help, my personal opinion, not a bad idea to get rid of some of that consumer debt or start paying that off. It'll definitely help out. If we get into volatile times, we get into, a stock market crash, and the last thing you want to have to worry about is your car payment of $500 a month, or, anything that you don't necessarily feel like you have to be paying for. If we can eliminate all that consumer debt with high interest rate, I definitely think it's worth it and something to keep in mind. Third thing I want to bring up to you guys is keep 10 to 30% of your wealth in cash or cash equivalents. Now, one of the main YouTube channels I have been following over the past like 3 to 4 years is Jeremy from Financial Education, and I learned this from him, and I've implemented this into my investing strategy for the past 3 or so years. And this is a huge reason why I'm comfortable with volatility, guys. And if we have a stock market crash, I have 10 to 30% of my wealth in cash or cash equivalents. That way I'm better prepared to take advantage of opportunities if I need to, okay? So let's go through an example. If you say, all right, Trevor, I want to start getting into investing. I'm super excited. I have $1,000 to invest. Let's say you have $1,000 to invest. Well, what I'm personally going to tell you guys is don't invest that $1,000. Instead, you want to invest between $700 to $900 of that $1,000 ideally. Why is that? Well, we're keeping 10 to 30% of the cash that you have available for investing. We're keeping 10 to 30% of that in cash or cash equivalents. So this means anywhere from $100 to $300 in cash. So what this does, guys, is it doesn't make you it makes it so you're not so emotionally attached to your investments. If we have that $1,000 and then all of a sudden we put that all in one stock or two stocks or whatever, and then the stock market collapses or we have some volatility, all of a sudden you're freaking out and you're going, what's going on? Like my money's now losing money, right? That's the last thing you want to have happen, as opposed to maybe we invest $700 of our $1,000, and maybe in the short term there's some volatility or a collapse in the stock market, right? And you're not all in the market. You still have some money. Maybe you can lower your cost basis. Maybe you just hold on to that extra cash. You're not so attached to that money, if that makes sense. I think that's super important. So gives you an opportunity to lower your cost basis. You're not so emotionally attached to your investments. And again, kind of a side note here, understand that I teach long-term investing in this YouTube channel. So the short-term kind of what's going on obviously is can cause a lot of people to be emotional. We'll get into that in a minute, but definitely be prepared that I don't want you to be investing. You guys can do whatever you want, by the way. This is what I've learned and what I do personally. But if I have $1,000 to invest, I'm not going to invest all $1,000 at the moment because of the reasons I just went over. Okay, so the fourth thing I want to talk about here is understand what you are investing in. Now, this is something that I personally didn't do for like the first year and a half, 2 years of me investing. I didn't really, apply this until later on. And what I mean by this is you guys have to develop a strategy. Okay, develop a strategy of what are you investing in, or why do you want to invest in the company that you're investing in? Does it follow your plan of becoming a dividend investor, a growth investor, a value investor, a blend of all three? You really have to understand that that you have to develop a strategy. That way you understand, are you taking too much risk? Are you taking too much risk in the market? Because if you don't know what you're buying, you don't know what you're investing in, you never know when to sell. And that's something I think a lot of people miss. They copy a lot of people here on YouTube, or Warren Buffett buys a stock, whatever. And they go, oh, okay, this person's buying this stock, so I'm going to buy it too. Well, that person that you're watching has a much different risk tolerance than you, most likely, right? They might have a much more different financial situation, and this might be a spec play to their portfolio, and you might be buying the stock as your main position. So I think it's something super important to, not only do your research on stocks, but understand, why you're buying it. What are some of your bullish cases on why you're buying the stock, and what is your sellout scenario? What has to happen for you to be able to sell out of the stock, or how do you know when to take profits? Because that's something a big thing that a lot of people don't get as well is, if a stock goes up a ton, they're going to take profits when maybe it's not time to take profits, right? It's just something to think about. You need to understand the business and the business model, how everything runs, so you can better understand if it's a time to take profits or not, or if it's just a time to hold on to. So definitely, think about that. And I personally suggest long term. Again, that's what I teach on this channel. That's what I like to share with you guys in my experience so far. It's all going to be long-term investing. Last couple things here, moving on to number 5, is diversify. Now, a lot of you guys may laugh at this one that watch my portfolio reviews because you realize that I am not very diversified at the moment. I literally have most of my stock market money in Apple and Tesla. However, I am working on diversifying my portfolio a bit more. And the reason it's not diversified right now is I was buying Apple and Tesla, 2 years ago or so, right? My average cost, my cost basis on Apple and Tesla is very, very low. So what happened was the stock took off, right? It did really, really well. Then they split, and it just looks like those are just massive positions in my account, which they are. But it's different as opposed to if I just started buying Tesla and Apple like 2 weeks ago. And that's the amount of equity I have in those stocks, right? So since I'm holding those stocks for the long term and I, love those businesses, I'm just going to continue to hold them, to be honest with you. I'm not going to, how do I say this? I'm not going to justify the valuation right now on those stocks, but personally, I'm just going to continue to hold. And if I want to free up some more capital, I can do that here in the near future. But, I definitely think for you guys, if you guys are getting started, you want to kind of hedge towards a stock market crash or volatility. Try and be as diversified as you can without being too diversified. You don't want your money spread too thin, obviously, but you don't want to be over diversified. Okay, I literally know people with $2,000 in the stock market, but they have 50 stocks. And there's no way you're going to keep track of 50 stocks, and your money's just spread way too thin. You're not building any equity realistically at all in those companies if you have $2,000 spread across 50 different companies, okay? So keep that in mind. At that point, guys, I generally recommend, you just buy an ETF or an index fund. If you're somebody who wants to be very, very diversified, you're like, Trevor, I don't want to buy individual stocks, but I want to get started in the stock market, I highly suggest you just buy an ETF or you buy an index fund. That way you're diversified. You're not have to actively manage your investments, and you just get the average, what the index fund, produces. And I think that there's nothing wrong with that. You just need to understand kind of what your, how diversified you want to be. And that's my recommendation there. It's definitely a way to minimize risk. All right. Now, the last thing is control your emotions. And I talk about this probably on every video because this is what helped me out so much on making decisions. Do not buy or sell based on emotion, guys. Easier said than done. 100%. I did a portfolio review on the JJ Buckner channel a couple days ago for you guys that have watched that video. And if you guys are here from JJ, I appreciate you being here and giving me the opportunity to talk to you here today. It means a lot that you guys checked out that video and checked out my channel. But I bring that up, guys, because I did a portfolio review on JJ Buckner's channel. It's got like 65,000 subscribers. And it was the worst day I've ever had in the stock market. I was down $30,000 on the day. And I was like, I'm literally about to show everybody my investments being down this much, right? But I didn't let my emotions get to me as far as, what my investments brought on that day. I've had some very high returns in a day, and I've had some very low returns in a day. Guess what? It doesn't matter to me because I'm long-term focused, okay? The short-term volatility, as long as nothing fundamentally changes with the businesses that I'm owning, I'm going to continue to hold, guys. I don't buy, sell. I have in the past, I'm learning as I go, obviously. But try not to buy or sell stocks based on emotion. That's something that can keep a lot of people from being successful in the stock market, okay? For example, guys, I think of somebody like Warren Buffett. If you look at how long Warren Buffett has been investing, quite a long time, right? Do you know how many times he probably could have sold out of his investments based on what, he's been through over the past many years of him investing? There's probably a lot of reasons that he could have told you where he could have sold out of stocks, right? And most of these cases, he'd probably tell you were outside of the stock itself. It was cases around the world, right? Wars and, all these terrible events that caused the stock market to absolutely panic and sell off, right? He could have probably totally, sold off most of his investments over the past couple of years. So understand that if you're going to buy or sell a stock, it should be from a place of a lot of thinking and based on facts and not necessarily emotion and, temporary short-term craziness that's going on in the world that we live in today, okay? So keep that in mind. I try my best to not get too high and too low on my investments. I also try to not check them every single day, multiple times a day. That's something that I kind of just thought of. I usually check in the morning, somewhere around the open, and then I check at close. I remember when I first started investing, I would check like a lot, probably like 5 to 10 times a day, how my stocks were doing. And honestly, it probably didn't matter as much because it shouldn't have mattered as much to check that much because, I'm a long-term investor. So I don't know what I was doing checking my investments 10 times a day. I guess I was just new and curious how this all works. But those are the 6 things that I have off the top of my head here that I want to write down, share with you guys how you can better prepare for a stock market crash or a volatile time or correction. Any of those events here. I'm not sure if we're going to have anything anytime soon. We are heading into an election year here pretty soon, so who knows if that's going to bring on some volatility. But just remember, guys, don't buy or sell based on emotion. Implement these 6 things into your investing strategy. I think it'll help you a lot better. Share this with a friend if one of your friends are worried about a stock market crash. Hopefully they get some value from this video, and hopefully I can kind of better guide them in a direction to kind of be prepared. So thank you guys so much for taking the time to watch this video. I really appreciate that. If you got any value from it, please consider hitting that subscribe button. Please consider hitting that like button. It would really help my channel reach more people. So thank you guys so much, and have a great rest of your day.